Good afternoon, financial professionals. Abby Fletcher here of E4 Insurance Services, welcoming you to the B.R.E.W, Building Relationships Every Week. Thanks for tuning in today. For those of you joining the B.R.E.W for the first time, we like to start the B.R.E.W-cast by celebrating today's National Day for December 9th. First up, today is National Pastry Day. Today, we celebrate one of the world's favorite baked goods and are encouraged to visit your local bakery to pick up one or two of your favorites. Pastries can be traced as far back as ancient Mediterranean, where they almost had paper-thin, multi-layered baklava and phyllo dough. Today, treat yourself to a bear claw or croissant to celebrate National Pastry Day. Also, today is National Christmas Card Day, intentionally serving as a reminder to get your stamps, envelopes, and cards together to spread your holiday cheer. Christmas cards originated in 1843 out of necessity in Victorian England, where it was considered rude to ignore a written message. Sir Henry Cole received lots of letters, leaving him little time to reply to all. He asked his friend to illustrate a card that he could easily send to all of his friends, and the Christmas card was born. Today, enjoy spreading your holiday cheer in your own way, whether it's a photo of your family with matching sweaters, or perhaps a letter recapping this wild year. Today on the B.R.E.W, we have our partner, Terike Novak, who serves as Regional Vice President of AIG Annuity. Today, she'll be sharing how successful financial professionals educate and assist clients in maximizing their retirement income and the common challenges that arise during the decumulation years. Feel free to use the chat box while Terike is live. I'll be keeping an eye out for your questions so we can provide real-time answers. Also, all attendees are in a drawing for a prize, and we'll be announcing the winner shortly. Thank you for tuning in, and without further ado, Terike, welcome. The mic is yours.
Thank you for joining us today. By the way, Abby, you had me at baklava. I love that pastry. As Abby mentioned, we're going to talk about how top advisors help clients maximize retirement income. You know, after spending years focused on saving for retirement, clients now need to figure out a way to convert their accumulated retirement assets into a reliable income stream that they can count on to support their retirement lifestyle. Basically, advisors and agents need to become income savvy. Before we share AIG's income maximization solution, let's discuss a client approach with 4 steps. The first being, let's identify the risk associated with decumulation. Next, let's talk about how we can see, there we go. Next, we can see common income planning approaches that have worked in the past, but are no longer working today. And then we also want to demonstrate how to demonstrate a process to help clients develop a client-focused income plan. Help them visualize the steps they need to take for their own personal plan. And finally, position and share AIG's guaranteed income solutions. So let's begin by quickly reviewing some risk of decumulation. One of the key risks that clients face is an unknown time horizon. How long of a retirement do they need to plan for? Before retirement, the time horizon is generally known. For example, a 35-year-old may be planning for retirement at 65 or thereabouts. If investment returns are lower than clients hope for, they have a choice. They can either save more or work longer. But after retirement, the time horizon is unknown because folks don't generally know how long they're going to live, or maybe if they're going to be forced into early retirement, as we have seen happen in 2020. Directly associated with market volatility is it's important to be aware of sequence of returns risk. Sequence of returns refers to the order in which clients encounter positive or negative returns, and how a client's investment is impacted by that order especially while taking withdrawals. During that decumulation period, clients' portfolios may be less able to weather market declines, and those declines will have permanent impact on how long their retirement income plan lasts. In this example, you see 3 clients. Both start out with $1 million at age 65. Each of those 3 clients have an average annual return of 7% over 25 years. Each withdraws $60,000 and it adjusts upwards annually for inflation. By the age of 90, all have different portfolio values due to annual withdrawals. Mrs. Joe, for example, if you look at her returns, early returns were positive 22, 15, and 12%. 25 years later, she ended up with more than her original investment, $1 million. Then Mr. White, unfortunately, he retired when market years were negative, -7 and -4%. Thereafter, markets turned positive, but the damage was already done. His retirement portfolio only lasted till age 88, and he's still alive. Mr. Rush, on the other hand, thought he's having it made. He's had the luck of the draw, having a 7% average annual rate of return every single year. Amazing. However, 25 years later, he can see that his portfolio is decreasing. And guess what? At age 90, he's still alive and going strong with only $430,000 of investable assets remaining. So now that we looked at some risk associated with decumulation, let's take a brief look at some common income planning approaches. One, maybe retirees have often turned to fixed income products to help generate predictable retirement income they needed. But unfortunately, the yields on many fixed income products have declined sharply. This can make generating income from these type of products very challenging. As you can see here, comparing 2007, 2013, and 2020, a 5-year CD is now under 1%, about half a point. A jumbo CD is not much any better. Separately, most of you have heard about the 4% safe withdrawal rate. Well, unfortunately, that safe withdrawal rate is no longer safe because declining yields from unprotected portfolio of stocks and bonds, the 4% rate is more like now a 2.29% rule. And that is in line with the moderate portfolio of a 50% stock and a 50% bond allocation. So keep in mind, that is a very low withdrawal rate. And that's only going to increase your chance for a 30-year retirement and your retirement income lasting a success rate of 90%. That's not even going to get you 100%, unfortunately. This table indicates the probable success rate of retirement portfolios with varying portfolio allocations and withdrawal rates. As we're looking at that's highlighted in the circles, the assumption here is with a 60-40 stock bond mix. And taking a 4% safe withdrawal rate rule that's adjusted for inflation annually thereafter, the portfolio has only an 80% chance that their retirement income would last for 30 years. 80%. In order to achieve 90% or greater on a 60-40 portfolio, we're looking at lowering that withdrawal rate to at least 3%. So now that we see that the past common income planning approaches may not be viable, let's identify how we can help clients, show them a simple process to help build their income-savvy client-focused plan. Keep in mind, AIG has a program that's called Income Savvy. It's a value-add program that can be in a virtual seminar environment. Ask me about that later. Let's identify with the client's approach with a needs assessment. Now, there's many ways to do this, but let's keep it really simple. One way is to help identify their retirement needs is to consider the retirement needs pyramid. Expenses in retirement can generally be categorized into one of 3 areas: essential lifestyle expenses, discretionary, and then finally legacy planning. Keep in mind, emergency funds here are not shown, but they're often need to be accounted for in the essential lifestyle. How do we maximize a guaranteed income solution? In addition to the Power Protector Index Annuity Lifetime Income Benefit, we're proud to offer you the Assured Edge Income Achiever. Let's talk about the ways that it can maximize income. Some of the key advantages as well are simple design with no income base. An annual income credit if the client's going to defer of a 6% income growth rate until the client activates lifetime income. There's also flexibility to make changes to covered lives, single versus spouse, or vice versa. And there is no market participation, so it's protected. There's also access to contract value, liquidity options, and the rider fee is 0.95% and declines as withdrawals are taken since it's calculated on the contract value. How does it work? Well, here's what we call a GLIA, which is called Guaranteed Lifetime Income Amount. It's what the client will receive when they make a written election to activate lifetime income. The product is single premium. You can add premiums up to 60 days from issue. But here are a few sample ages. The income percentage is basically age-based, and there's one for each and every age, even though all ages aren't shown here. Please note that when joint coverage is elected, the initial income percentage is always going to be based on the younger covered persons. A simple way to identify what those age bands are for all ages, as well as to calculate them, we have the Placemat that's in the AIG Annuity Playbook, as well as the Assured Edge Income Achiever Web Calculator that is not behind a firewall, and that can also share with you the income Placemat, as you can see here, that identifies each and every age of the client as single life versus joint life, and also it demonstrates how much that income GLIA amount would be if they were to defer it 1 year, 2 year, or how many years out. We try to keep it simple and make it simple for you. Going back to the slides. So how can we improve a client's income reliability ratio and maximize that income? Well, let's take a closer look at an age 65-year-old sample client, $800,000 savings with $19,250,000 income gap. We're also going to look at how we can reposition a portion into the Assured Edge. Remember, the common income planning approaches is if you were to start out with a 3% systematic withdrawal off of an unprotected portfolio, you could start out with an initial investment that's providing that 3% of $641,000, but it's a disciplined approach, and it only leaves the client flexibility of $158,000 for discretionary expenses. On the other hand, if we were to push to be a little more aggressive on an income, unprotected with a systematic withdrawal, we would need $481,000 to create that same amount of income, $19,250, but again, only leaving $318,000 for flexible discretionary expenses or more moderate aggressive investing. But take a look at AIG's income maximization solution. How much will we need to solve for that same $19,250? Well, I don't know if you guessed it, but we would only need $337,000. That leaves $462,000 for discretionary, flexible, and maybe even some more moderate to aggressive investing. What a great solution. Clients can cover their essential lifestyle expenses with definitely a lower investment amount, potentially leaving more money for discretionary expenses. So today we talked about 3 things: decumulation risk in retirement, common income planning approaches, and how to help a client maximize their retirement income with Assured Edge Income Achiever. We believe that you can offer your clients an annuity with income protection. You can help them offer a more predictable, smoother, and comfortable retirement. With that, thank you for joining us today. Back to you, Abby.
Thanks, Terike. Great share. I've opened up the line for questions from the audience. While we await those questions, Terike, you did make reference to virtual selling on the retirement pyramid. You've got about a minute. Do you want to share a little bit about that?
Absolutely. We have a playbook here. It's in our master annuity playbook.
Got it.
My screen.
You sure do.
And by the way, this playbook has been modified. So we have what's called programs and resources. Learn more. And here's our income savvy flip book, sequence of return client calculator, which I identified in that one of those slides. And behind this, we also have our Connects agent access system, admin system, that provides you with the client seminar, PowerPoint, as well as other additional client materials and brochure that does a self-calculation on how to develop that retirement income plan.
Fantastic.
Complimentary, of course.
Excellent. I'm not seeing any questions pop up. For those of you in the audience, we will attach all slides that Terike spoke to her brew on our brew blog. So now, Terike, I'm going to ask you to look into your virtual top hat and give us a number between 1 and 17.
I've always liked the number 6.
Okay. Who's the winner? Steve Hauser. Congratulations, sir. You are the lucky winner of today's coffee card. Be on the lookout for an email coming your way from all of us here at E4. Thank you for joining. And be sure to tune in next Wednesday. We'll have E4's very own John Florence talking about intentional business planning. Thanks, friends. Happy December and have a great day.
Thank you. Take care, everybody.